Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. No relief for Boeing. The plane maker faces continued strike activity as workers reject the latest wage deal. Tesla shares soar post-market after reporting its most profitable quarter in more than a year. Elon Musk sets out an ambitious rollout for robo-taxis. Plus, earnings stories this morning so far look mixed. We have numbers from Barclays, from Hermes, Anglo-American, Unilever crossing the Bloomberg terminal right now.
In the meantime, a quick check on these markets here. From a macro standpoint, the FTSE 100 set for some outperformance at the open, higher by about 0.3%. Compare that to Euro Stoxx 50 futures, which are virtually flat right now. A bid into the euro, a bid into the U.S. Treasury market, 107.87 on euro dollar. And yet, yields lower already by 3 basis points on the 10-year in the States. The countdown to the opening trade starts right now.
Thursday morning, good morning. It's the 24th. It's a similar story that we saw yesterday, to be honest. We are watching the bond market very, very carefully. That's where the action is. But the story this morning, once again, as the earnings flood in, is in the single stock story. We've got Barclays, we've got Hermes, we've got Anglo-American, we've got Unilever. We've got lots of stocks to work our way through. Let's start with Barclays.
Yeah, let's start with Barclays and the investment banking division delivering as expected. The pre-tax profit coming in higher than had been anticipated. What we're looking for here is there evidence of M&A picking up? IPOs, that's not been the case so far, but M&A, there have been tentative signs of that. Lots of US banks talking about that. Volatility helped the US banks. They delivered strong profitability. Many of the stocks went to records, so that's also going to be part of the dynamic when you're dealing with a bank such as Barclays. And more on the UK lending side of things, described by analysts as having a structural hedge. So as interest rates come down, what is that doing to the business? They are giving some guidance on UK net interest income, for example. So we continue to watch that, broadly sticking to their return on tangible equity target. So that's the story out of Barclays.
Let's go from the financials to the luxury space, because it's a tale of two very different luxury companies, but perhaps one that we are very familiar with. Hermes numbers coming out here. It looks like their sales are actually beating the estimates. Remember, this is coming right off of the heels of Kering in the last 24 hours, which showed the exact opposite. And it really comes to one thing, Anna and Guy, and that is the Birkin bag, the Birkin to the rescue. The idea here simply being that whereas in the words of our luxury reporter Angelina Rascoway over in Paris, aspirational customers out of China have been the Achilles heel of the story out of Kering. Again, Gucci really being the major drop there. Hermes, on the other hand, catering to a much wealthier client. Birkin bags, again, seem to be popular.
I'm going to go to the other end of the spectrum and talk about sort of ice cream and other important things like that. Unilever, the spin of the ice cream business is pretty much on track. Let's talk about the sales numbers. Look pretty much in line with estimates. The volume looks a little ahead of estimates. The underlying pricing looks a little softer than estimates. Unilever keeps expectations unchanged. I can also mention Anglo-American as well. It looks pretty much in line with expectations in terms of copper production and what is happening in the diamond market. So not really much, I think, to take away from either of those two stock stories. We'll see how they trade at the get-go. Let's talk a little bit about Boeing. So we had Boeing numbers yesterday, but we also had this key vote yesterday from the IAM union. The union has voted to continue the strike. This time it was only by 64%. Last time it was 94%.
Progress.
So the number, yeah, well, precisely. We are starting to make progress, but we're not making progress in terms of the pension story, and that is where the sticking point still lies for the union. They want their defined benefit pension back from Boeing, and that is where the sticking point lies, because Boeing hasn't put that back on the table yet.
Yeah.
It's raised wages, but the pension problem remains.
That's a big ask. I mean, I'm not sure it's so much the US context, but, you know, these defined benefit schemes, they were starting to be replaced by defined contribution, the likes of 401k, back in the 1980s, and that process has just continued and continued and continued elsewhere. So we'll see whether they make any progress on that. Meanwhile, Boeing faces a difficult financial situation and the potential of a ratings downgrade.
It's got a ratings downgrade as potential. It looks like it's going to continue to burn cash into 2025. That's a massive problem. Kelly Ortberg yesterday on the call with analysts talking about how he is going to try and turn this business around, but it's going to take a long time. He's got some big boulders that he needs to shift. He's going to slim the business down. That certainly seems to be the strategy going forward. I think there's going to be a much bigger focus on key defence contracts, but the main focus is going to be on the civil side of the business. But a massive challenge, and that challenge gets even greater as a result of the fact that this strike is going to continue. How much longer it continues for, be interesting to see. Acting Labour Secretary The acting Labour Secretary has been there talking to them. Is she going to be able to make any progress?
I imagine this impedes their ability to address some of the innovation challenges and design challenges and safety challenges that the regulators are also hitting, right?
Well, they're going to need a new aeroplane, and Altberg was talking about that yesterday on the call. That is something Boeing needs to continue to innovate. The MAX basically is the last iteration of the 737.
Yeah.
It is going to need a new aircraft at some point. Hugely expensive. How's that going to happen? When is that going to happen? He's saying you can't take your eye off the ball on that story. But they're going to continue to burn cash into next year. That's the takeaway. And how do they get away from that?
This is a really scary one because, of course, now Boeing is being called one of those too big to fail companies. This is one of those kind of critically national security companies for the United States. We don't really know.
But it could be the biggest fallen angel that we've ever seen if it gets downgraded to junk.
In history. Perhaps creating a bid for the Lockheed Martin debt, though. There's a market story that we got to get into later. Let's talk a little bit about what happened with Tesla as well. The deliveries coming in stronger than expected. So you did see a bump in those deliveries, but not all is well in the Tesla space. And I think this is really interesting because you did see, yes, sales were, like I said, bumping up in contrast to some of the pullback you've seen deliveries for some of the European car makers as well, the likes of Volkswagen, et cetera, when we're talking about the EV space. But sales actually were down about 1% versus estimates. EPS coming in a little bit higher. The gross margin was a bit higher. Free cash flow was a bit higher. But sales did not really make up the difference that I think a lot of people were going in expecting.
Yeah, we'll talk to Craig Trudell later in the programme about this, won't we? I mean, he was mentioning the sale of greenhouse gas credits just the other day when he was talking about one of the criticisms that lots of the rivals, or one of the things lots of the rivals need to point out, and they do continue to make a lot of money, more money in a shorter space of time from the sale of those greenhouse credits. So, you know, that's always something that other car makers like to look at. And there were some strange things in the cash flow as well, boosted by accounts payable, so basically suppliers that they have not paid yet.
Yeah, this is amazing.
So all kinds of interesting detail, I suppose, in there. And as they are sticking to that delivery target for 2024, it really does point to an incredibly high target for deliveries in the fourth quarter. So we'll see very soon whether they manage to turn that around.
So Liam Denning's written a really nice opinion piece on this. Musk has now pledged new, if unseen, models, a big re-acceleration of EV sales growth and actual self-driving cars in at least one state, all within roughly the next 9 to 12 months. That's an amazing set of... I
mean, with the self-driving scheme, we are used to the idea that there's a stretch target and then you can't quite stretch
Big
to meet
promises.
that target.
Well, he's talking about a new car going into production at the beginning of next year. We have what car? Where is this car? I haven't seen it yet. He's talking about this happening very, very soon. There's a lot of expectation that was laid out last night. Delivering it looks difficult. OK. Let's talk about what we're going to be doing next. We've got some great guests lined up to talk about all of this. Of course, Althea Spinozzi, Saxo Bank's fixed income strategy, is going to be joining us. There's so much to talk about in the bond market right now. At the Open, and Doe from Julius Baer is going to be joining us. Citi's head of family office group, Haynes Hoffman, is going to be coming up to discuss the latest outlook. They've got a great report out about what those family offices are doing. You've got to remember as well that we've got PMI data throughout the morning as well. That's going to be fascinating to see just where Europe is and maybe give us clues as to where the ECB is going to go next. Maria Demetsis is going to be joining us a little later on to work our way through all of those numbers. What are they going to tell us? Are we going to see services in Germany below 50?
Certainly something we're going to be keeping a very, very close eye on with all those guests. And then, to your point, those global PMIs, we'll walk you through when we actually get them. 8:15 a.m. time, we get France. 15 minutes later, Germany. It's going to be an exciting second hour of this show as we, of course, wait to get those full numbers at about 9 a.m. UK time. And then after that, at about 9:30 a.m. UK time, yeah, I'm doing my math right. 1:30 p.m. Unit Essential. Basically, we're getting a lot of data on both sides of the Atlantic. I think the PMIs are crucial in Europe, and then central bank speak is crucial over in the States as well. We get Bowman, we get Barkin, we get Bailey. Remember, Bowman is the major hawk on this FOMC committee, so it'll be interesting to see whether she moves the market, especially given the Fed beige book that we got yesterday, slowing growth across all major sectors.
It's weird because it doesn't match the data. The data are telling you a different story to what the beige book is telling you. The beige book is telling you a story of a slowdown. The data are telling you, the hard data are telling you a story of a re-acceleration. Do we worry more than the actual data suggests we should? I was quite taken by some of the Bailey lines yesterday, not because they were particularly new. We've heard a lot from Bailey this week at the Bank of England, and more to come later on today. But the fact that he keeps saying it, keeps talking about disinflation happening faster than they had previously anticipated. You know, he's pushing in the direction, to your question yesterday about whether the UK is more like Europe than the US, he's certainly pushing the bond market to think of it more like the Eurozone than North America, at least in terms of rate cut expectations in the immediate future, even if the underlying data there isn't consistent. It does reinforce this idea that maybe they go again in November. However, he also talked about sticky services inflation, and that remains a real key concern. So that is more akin to what we're maybe seeing in the US, where services inflation does remain very sticky, and certainly that is borne out by a lot of the data at the moment.
Well, what's interesting as well is coming at a time when, if you look at some of the corporate news, your Targets, your Walmarts are actually looking at price cuts in terms of some of their products. That's not something you hear from the corporate sphere very much because of that reason, because of the stickiness, because of the wage pressures that they're feeling. And yet, they're really keen about keeping the consumers intact. So Target, for example, which is known for expensive groceries, is actually cutting their prices.
They are, but if you take a look at in the service sector, you look at it looks like airline fares are beginning to bottom out a little bit, could re-accelerate to the upside.
Yeah.
Other areas within the hospitality space, hospitality is the biggest global sector. You're beginning to see again wage demands ticking up again, service sector inflation ticking up again in those spaces. So that's an area that the Fed and the Bank of England continue to watch very, very carefully.
There are a number of other corporate stories, are there, this morning we need to get to?
Let's talk about those. That's Anna basically telling me to read on. IBM falling in late US trading after disappointing sales for the third quarter. The company hurt by a slowdown in consulting demand. Revenue rose 1% in the period, just missing analyst estimates. The CFO says clients aren't expanding budgets and some generative AI products are coming at the expense of traditional consulting. Intesa Sanpaolo is planning for 9,000 staff exits by 2027. Is that the new way we're putting that, staff exits? That's after Italy's biggest banks struck an accord with the trade unions as it seeks to boost profitability and curb expenses. The reductions comprise 7,000 staff in Italy and 2,000 in the international divisions of the bank. In a CNN town hall, Vice President Kamala Harris deepened her closing arguments to undecided voters in the United States, saying that Donald Trump is unfit to serve a second term, describing him as, quote, a fascist. The comments come as both candidates undergo a media blitz with less than 2 weeks to go until the election. November the 5th is coming quick.
The world is poised to change in a very big way in less than 2 weeks. It's kind of mind-boggling for those who have cast their ballot. I think what's interesting, though, is that you can really see these kind of last-ditch efforts on both sides of the candidates to really get that vote. Of course, Kamala Harris making some very strong comments on the back of John Kelly, who is a member or former member of Trump's cabinet, talking about some references to basically Nazi Germany and idolizing some of the things that they did in private conversation. At least that's the allegation on President Trump as well. Kamala Harris harping on that immediately, really kind of embracing the strategy that Joe Biden had, which is this is a binary choice. It is Trump or no Trump. That is how you have to think about this election.
But she was asked about it, though, wasn't she? She was asked whether she would agree with that sentiment, and she said, yes, I do. So just to give that sort of also that context. But interesting, we saw that the polling coming out of 7 swing states. I mean, there's just nothing in it. Nothing between them. Absolutely nothing between them, it would seem. Really interesting to see the things that they win on. So Harris doing really well on mental fitness for office, on honesty, on compassion, and by a wide margin for some of that. Trump doing really well on the fact he's experienced, patriotic, and a strong leader. He also does slightly better on the economy than Harris. But, maybe that comes down to what do you want from a presidency? What is the United States of America president all about? And maybe you reference those points when you make that decision.
The bond market is, though, pricing in a red sweep.
Yeah.
That's the narrative that increasingly has been factored into the asset market. Certainly that seems to be the story over the last few days. Now, what that has been driven by, it's hard to see that in the polling, but certainly the betting odds seem to be fairly well correlated with what we're seeing in the bond market.
And I think the key piece of it that Anna was talking about as well is in terms of the criticism for Trump, the criticism for Kamala Harris, that she is still VP of the Biden administration.
Yeah.
If she's talking about being different from her predecessor, how?
That's when you talk about the world changing in 2 weeks. Does the world change in 2 weeks' time if Harris wins?
That's the criticism.
Well, somebody who has some interesting views on this is our next guest, because actually she gives us some suggestions as to where bond yields go if we get a Trump president, but also how low they drop under Harris. And that is interesting, because is she a continuity candidate or not? We can get into that conversation. Coming up, we will check in on the Hermes story and some of the other big corporate earnings reports this morning. We'll certainly do that ahead of the open. Plus, Siemens is said to be in talks for $8.5 billion deal to acquire the software maker Altair Engineering. We will check on the Siemens stock price at the open. Up next, crucial PMIs due today. Out of Europe, we'll take a look at the data and what to expect. We'll also have lots more on the way that politics is playing into bond markets right now. If you want to get involved in any of those conversations, IB plus BBTV Go, that is the function that you can use on the Bloomberg terminal. This is Bloomberg. Welcome back. This is the opening trade. We have still 42 minutes to go until the start of the equity session, and you can see that futures are pointing a little bit higher, though, this morning. We will see how that futures picture withstands some of the incoming data this morning. PMI data is due from France, from Germany, and for the whole of the euro area. That's a little bit later on in the morning. We will build a picture gradually of this European growth story. Bloomberg's Valerie Teitel has more on what we can expect. And I correct myself, Valerie, of course, all of this data coming just after the markets have opened this morning.
Anna, it's a big day for the European market as Lagarde has really stressed this data dependency. We're going to be very sensitive to the PMI data coming out today. Now, in last month's print, notable that the European composite did fall into contraction, as well as the French indicator here on this chart. But the contraction isn't really seen to be picking up steam. If you flip on to my next table, yes, a lot of these indicators are expected to remain in contraction, but the acceleration into contraction territory isn't expected to be evident in today's print. Actually seeing the German composite a bit rosier than the prior month, as well as the French composite as well. But this comes alongside of many dovish leaks that we've heard from the ECB just in the last 48 hours, notably the one out from Reuters yesterday that talked about that there is a debate on the governing council about whether they need to take rates below neutral. We heard many ECB members talk alongside the IMF yesterday, the Dove Panetta mirroring that Reuters leak that the ECB can't exclude that the ECB could go much below neutral. We also heard from the Hawk Holzman talking about how the market pricing of cuts is likely too aggressive. Perhaps we'll see some validation of what the market is pricing in today's print. We are currently pricing a 40% chance of a jumbo cut from the ECB come December.
OK, let's get another perspective. Valerie, thank you. Let's speak now to Althea Spinozzi, Head of Fixed Income Strategy at Saxo Bank. Althea, as we were saying before the break, we do really want to get to your thoughts on treasuries. But just as Valerie's nicely set up this conversation around the data that we get from Europe today, let's start with that. How much likelihood are you putting on the idea of a jumbo cut from the ECB? And do you think the data we get today will decide that, or we have to wait longer?
Well, I think that we will need to wait for all the data that we are going to get by December. Really, I don't think that the ECB will go 50 basis points for the simple reason that they normally act dovishly, but in a balanced way, especially when, yes, we have a stagnating economy. The German economy actually is in a recession, but inflation, core inflation remains above target and wages are still well above where the ECB wants them to be. So I would exclude at this point a 50 basis points rate cut. What I am prepared is for gradual rate cuts to go throughout 2025, possibly taking the ECB deposit rate down to 2%.
If I think about Germany right now, Althea, you say that Germany is in recession. We have, if we expect rates to be cut, maybe that does something to stimulate the German economy, but maybe the cuts are not enough for Germany because other areas of Europe are more resilient. What kind of pressure does that put on fiscal actors to do something, even if they are very constrained?
Well, Anna, that's a very good question. Next year, we are having a general election in Germany. And while it is true that rate cuts might help the German economy, they definitely will not be enough to enact a structural change within the German economy. So basically, automakers are not going to get back if the ECB cuts interest rates. We need a structural change. And that can only come from the political side. And that's why I'm monitoring what is happening with the fiscal situation. I think that Germany will need to take debt, and that will put upward pressure on bonds. And that's why I see them more likely to go towards 3% than below 2% at this point in time.
Althea, you talk about the German election next year. Let's talk about another election on the horizon. That is, of course, in the States. In your notes, you talk about a yield as high as 5% in a Trump 2.0, as low as 3.6% in a Harris presidency. How does the U.S. election affect the rate path for the Federal Reserve?
Well, the Federal Reserve is set into cutting interest rates and get them more or less into neutral territory. The problem with the U.S. election is we have a president, Trump, that is going to cause growth and probably put pressure on inflation imminently after he's elected. And that probably is going to slow down the rate-cutting cycle that the Fed is set up to. So that's why I believe that in this scenario, the 10-year yields is likely to move up towards 5%, which Kriti is not unrealistic in the meaning that we have to bear in mind that the 10-year yields are an expression of the nominal growth of a country. And right now, the U.S. has a GDP above 3%, inflation above 2%. So at 10 years, around 5% or slightly above, it's definitely realistic.
Okay. Let's talk about the 3.6 with a Harris win. Why do we get to 3.6? All I'm hearing from bond desks at the moment is that term premium is rising, the market is worried about issuance, the size and scale of that issuance is going to be significant with a Harris win. Why do we get to 3.6 if that's what trading desks are talking about?
The 3.6 is a yield estimate that I put in the short term after Harris is elected. And the reason for that is that while also the policies that Harris want to enact are pro-growth, they really focus on the long-term growth of the country. But they look at increased regulation, increased corporate taxes, which is going to be bearish for the stock market in the short term. So if the stock market takes off some of the froth that we are seeing right now, what we can expect is U.S. Treasuries to gain because of rotation from risky assets to safe assets. And that's why the initial push down to 3.6%. However, as you say, Guy, the problem is that we have a massive deficit problem in the U.S. that is unlikely to be resolved in the next couple of years, and that's going to push yields back up towards 4%. So in the Harris scenario, I believe that there is going to be an initial drop in yields, but then the 10 years should stabilize around 4% in the long term.
Great to catch up, Althea. It's going to be really fascinating to watch. Althea Spinozzi, head of fixed income strategy at Saxo Bank. What I find interesting at the moment is that the bond market is reacting to all of this. Equities aren't. Equities seem completely unconcerned about this election.
And Althea was directly linking the two there. She was suggesting that in the short term, equities, if we see a Harris win, might do badly, in her view, and then money gets pushed into bond markets in the short term. We'll continue to have these conversations, no doubt. Coming up, more turbulence for Boeing as the company's third quarter earnings disappoint, and, of course, they fail to reach a deal with striking workers. That massive uncertainty hanging over the business. This is Bloomberg.
This wasn't enough for our members. We couldn't reach, especially when it's been 16 years since we've had a chance to bargain every area of our contract. And trying to make all that up in one is very hard to do, but our members deserve more. They've spoken loudly, and we're going to go back to the table to try to achieve those things.
751's John Holden, the head of the union representing many Boeing workers. This after the latest round of talks failed to find an agreement over pay. It's actually really over what is happening with the pension plan at Boeing. The pay looks like it's reasonably well settled. It's now the pension issue that has got to be resolved. It's been a busy 24 hours for Boeing. This, of course, as the company has announced also its latest set of results. Cash burn is going to continue into next year. The business is grappling with this labour strike. It's got a significant regulatory scrutiny that it's got to deal with as well. And it's got to think about what comes next. How does this company innovate? The 737 program has probably reached its conclusion. They are at some point going to need a new aircraft, a new narrow body to replace it. But that comes later. There's some huge problems that have got to be dealt with between now and then. Boeing's new CEO, Kelly Ortberg, was talking to analysts yesterday. This is what he had to say.
Boeing's an airplane company. And at the right time in the future, we need to develop a new airplane. But we have a lot of work to do before then. This includes stabilizing our business, improving execution on the development programs, streamlining the portfolio to do what we do well, and restoring the balance sheet so that we do have a path to the next commercial aircraft.
It's been a 24-hour process, 24 hours of amazing coverage coming out of our transport team. Katrina Nicholas, Bloomberg's transport editor in Asia, joining us now. So, Katrina, it's been 24 hours of Boeing results. Then we get the result from the union. 64% vote against the deal. Now what? Where does this leave Boeing?
Yeah, well, look, as you said, this really deals another big blow to Boeing, already a very embattled company. Some 64% of union members who are casting those ballots on Wednesday voted against the tentative agreement, saying in no uncertain terms that they remain on strike. You know, they said that Boeing's latest pay offer, which was 35% over 4 years, a bump up from the initial 25% that was on offer. Workers are still very angered by the failure to reinstate their defined benefit pension plan. So it is back to the drawing board. It is back to the negotiating table for both the machinists union and the company. And meanwhile, this is a plane maker that has been forced to suspend work on its workhorse 737 plane and also the larger 767 and 777 airliner models across its Seattle area manufacturing hub for more than a month now, weighing on its finances very heavily and putting credit rating companies on alert for a possible downgrade to junk status.
And so, as Guy said, Katrina, just before we got the vote, we got the numbers. So talk us through the state of the numbers, given they haven't been able to operate in a number of locations at full strength for quite a while now.
Yeah, well, the focus of the third quarter was very much around cash, and more to the point, cash burn. Free cash flow is set to be negative in the first half before perhaps turning positive in the later half of the year. That was something that Chief Financial Officer Brian West told analysts on an earnings call after the numbers dropped. Boeing has drained more than $10 billion in cash in the first 3 quarters, an astounding number there. New CEO Kelly Ortberg saying that all the financial forecasts, any sort of long-term outlook here are really off the table and under review. And he needs to see some stability in this business before he can start putting any kind of targets out there. The ongoing labour strike obviously isn't helping at all with Boeing's cash crisis. But there's also other things that are playing into effect here, including the cash that's needed to prepare for the much-awaited entry into the market of the delayed 777X long-range jet that's expected to start coming into service in 2026. That's also weighing quite heavily on Boeing's cash flow right now.
All right, Bloomberg's Katrina Nicholas walking us through some of the numbers around Boeing. We thank you so much for joining us around the program. Look, this is something you've been following, Guy, very closely in terms of the pain that it's causing Boeing in terms of its financial analysis. But I'm curious what the next steps here are. How do you even find a way out of something like this?
Got to deal with the unions. You've got to figure out what that looks like. In terms of the overall cost of building an aeroplane, actually the input costs from labour, you could argue, are relatively small. So you could argue that Boeing actually just needs to get this deal done, figure out a way of getting its workers to get on board with what comes next, because that's really important. Boeing has got to also change its culture. The culture has become a bigger and bigger problem, and we've seen that resulting in what happened with the 737 MAX, the door blowout. All of these things, you can argue, relate back to the culture of safety, and getting workers on board with rebuilding that culture is absolutely critical. You can't do that if they're annoyed.
Yes, you can't do that. Yes, absolutely. If they're annoyed, if they're on strike, it's not that's not the sort of the backstory to reinventing your culture. In the meantime, he's cutting costs, isn't he? Trying to take out things he can. He's already taken out 10% of staff, and others in the sector also looking at layoffs.
And there's talk. There's chatter that maybe more layoffs are coming. He basically wants to run a slimmed-down Boeing. He's looking and trying to figure out ways of making that work. He needs to focus on the core of the business. There's some defence contracts there which he's not going to walk away from. He's going to continue to focus on those, but it's the civil side of the business that he needs to get slimmed down, focused on. He needs to bring spirit back into the business and figure out how to get everything firing back on all cylinders, get the safety concerns, the regulators back on track, and then he's got to build this new aeroplane as well, because Airbus is going to be thinking about that as well. The next generation of narrow bodies is critical to this company's future. So he's got to get that one right. And that's coming hurtling towards this company as well.
It's fascinating. I'm curious to see how it all shakes up, and also what kind of precedent it sets for some of the other labor movements around the world. A completely different story at Tesla, by the way. Shares jumping in late U.S. trading after a surprise blowout quarter. Earnings buoyed by sales of the Cybertruck, which turned a profit for the very first time. Musk also gave a pretty upbeat forecast for next year's numbers.
I do want to give some rough estimate, which is I think it's 20 to 30% vehicle growth next year. Notwithstanding negative external events.
Let's bring in Bloomberg Global Automotive Editor Craig Trudell. All right, Craig, a lot to digest in some of these numbers. Talk us through some of the highlights.
Yeah, I think the audio we just played, 20 to 30% increase in sales next year. I think the big question for me and reaction I had to that was how? Where is this going to come from, right? I mean, I think they're selling a decent number of Cybertrucks. I do think that give them credit for selling a lot more of those than people thought, especially at the price points that they've been selling those. But those are a fraction of the volume they do with the Model 3 and the Model Y. Give them credit also for the earnings performance this past quarter. I think it wasn't something they achieved from top line growth. It was really a matter of cost and strong performance and sort of operational performance. But how exactly this company is going to grow again, I think, is still something that wasn't really sort of clearly addressed by the call. There was a lot of hand waving about autonomy and ride sharing and things that we've heard for years and years that we haven't necessarily seen actually come to pass.
And so the stock, though, responds really positively,
really
Craig, up by 12%. And I think going into these numbers, options pricing is suggesting we weren't expecting a lot of volatility, because sometimes the thing that creates that volatility is the self-driving stuff, and we'd heard quite a lot about that just earlier this month, didn't we? And yet we get this really big pop. Some of our opinion writers talking about some of the things that sort of flattered the numbers to some degree. I mean, what did you take away from the positive stock reaction?
Yeah, I think often you want to look at regulatory credits, which I think years ago even Tesla would say, well, we expect our competitors to eventually sell more electric vehicles, and we can't count on this being a sustainable business. Turns out it's quite sustainable. A lot of their competitors are having trouble keeping up with their EV sales. That was the second best quarter that they've had in terms of sales of regulatory credits. The other factor that we'll hopefully glean a little bit more detail from the 10Q filing is recognition of deferred revenue that they generate from selling what they call full self-driving, which is not a self-driving system. Don't ask me, ask Tesla. And so what they do is they collect revenue and defer recognition of it until they've deemed themselves worthy of it on the basis of certain performance milestones. And so it's really a sort of strange, arbitrary thing that some of the analysts want to back that out as well as sort of special items. So even backing out some of those things, I do think that profitability this past quarter was much better than was feared.
Where's the new car? Where's this new affordable car that's going to make these numbers work next year?
I think my best guess is that a refreshed Model Y is on the way. And I don't think that we have seen the refreshed Model 3 really move the needle. That being said, the Model Y is and has been their real sort of breadwinner. And if they can make more substantial improvements to that vehicle to get people interested in that again, they've proven that they can make that a big volume vehicle, and maybe they're counting on that.
Does it become more affordable?
I think maybe if you put a smaller battery in it, but then there are some questions about whether that trade-off is worth it to the consumer. And so, aside from that, I mean, he made quite clear last night that this idea of a sort of quote-unquote Model 2, it ain't coming. So, so let's hope that we have some cheaper Model Ys on the way, because otherwise I don't know how the heck you get to 20-30% growth.
So Tesla, some pretty decent numbers, loved by the market after hours, higher by 12%. Renault also coming out with some surprising turn. What's Renault doing right that the rest of the EV makers are not?
Well, it's interesting. I think, we've seen just one after another European manufacturers come out and do profit warnings. And so, usually I don't get very excited about, maintaining outlook, especially this late into the year. But Renault coming out and saying that they hold to their guidance, I mean, it really makes them an exception among the manufacturers locally. I think this is a story of a company that was sort of deeply troubled when Luca De Meo came in. And to his credit, he's really stabilized things and sort of injected some life and some reason to be optimistic about this company. I think the R5, the Renault 5 electric vehicle, looks really neat. It is sort of widely praised and highly regarded in terms of reviewers that have gotten some seat time in that. So I do think even they, though, caution that there's going to be some challenges with meeting next year's CO2 regulations in the EU.
OK, that's interesting. Let's talk about some of those regulations and how committed to them some of the politicians around Europe are and what the car companies want to see. We caught up yesterday with the German Finance Minister, Christian Lindner, and in a Bloomberg TV interview in New York, he was asked about the changing regulatory landscape around combustion engines.
The end of the combustion engine in 2035 is not only too early. I think we do not need that date. We should be open for all technologies, and even the combustion engine is possible to be used climate neutral with synthetic fuels.
So I've never got the feeling that he's a huge fan of EVs, but he makes the point that do you need to have a cut-off date? Can people just move to EVs if they want to, and leave a few people still driving combustion engines if they want to? How widespread is that view in Europe?
I don't think particularly wide. I think obviously Germany is quite important in that conversation, given the size and importance of the industry to the German economy. I think I'm a little bit dispirited that Germany refers to this idea that these rules need to be neutral. They are neutral. You just need to eliminate emissions by 2035. I don't think we actually have evidence that e-fuels or green fuels, quote unquote green fuels, are ready to get the combustion engine to the point where they really are climate neutral. So I'm not really sure about some of the comments that you hear about Germany, but you can get there. You don't have to get there by way of battery electric vehicles. But I agree with you. It does seem that he's not a particularly big fan of them.
Don't tell the aviation sector that e-fuels aren't going to be the way forward, because that's going to cause a massive problem. Craig, thank you very much indeed. Craig Trudell, our automotive editor, having a busy morning. Coming up, we're going to talk about what is happening in the luxury sector. The Birkin bag maker Hermes reporting a rise in sales, bucking the broader luxury market slump. More on that and other stocks we need to be watching into the open. That's all coming up next. This is Bloomberg.
As a result of a long period of zero to negative inflation, inflation expectations have been changing very, very slowly. And that was, in a sense, lucky for us in our attempt to normalize policy, although it's still taking time for us to get to 2%.
Bank of Japan Governor Kazuo Ueda there speaking at the IMF annual meeting in Washington. We do have a slightly stronger yen this morning, 152.12, up 0.4%. Let's talk about the broader market themes, though, with our Markets Live executive editor, Mark Cudmore, with us this morning. And, Mark, we've talked a lot about bond markets and why we're seeing the higher yield story being factored in. I'll linger there unapologetically, because it does seem to be something of an obsession. We spoke earlier to Althea Spinozzi. He was saying she sees higher yields on a Trump presidency. She says she sees a slightly lower yield in the short term, but then eventually a higher yield under Harris. So all roads lead to higher yields, do they?
I think that's probably the case. Yes, indeed. I think, first of all, you know that I've been in the camp that all year that we've been over-aggressive in pricing Fed cuts, that the level of Fed cuts that were priced and are still priced implies an economy that is going off a cliff and into a recession or a crisis. And there's no sign of that just yet. So therefore, I think we're going to continue to price out rate cuts. So that's one dynamic. And I think the other one is both presidential candidates plan to continue to expand the fiscal deficit. So that's going to continue to put upward pressure on yields at the long end. And that, I think that'll add into the term premium. Plus, I think the final dynamic is inflation will remain sticky. I think the Boeing strike story reflects that sticky components of inflation. These are workers who are rejecting a 35% wage increase over 4 years, not because a company is doing so well, it's hemorrhaging cash at the moment, but because they cannot cope with the cost of living increase the last few years. And despite the fact that oil prices are contained, we are seeing commodity prices more generally head higher all the time. Inflation is still with us. It is not a slain dragon.
At some point, stocks are going to have to react to this. Is there a line in the sand, let's call it 5%, where the stock market starts to react to the bond market story?
No, there's not a line in the sand. You're absolutely right. There's a point this will react. And I think that's what ultimately breaks the stock market. But at the moment, the stock market is saying, hey, this is no problem at all. The key things to look at, earnings, first of all. Earnings are perfectly fine, continue to grow. I think the other part is the consumer, when the consumer gets sufficiently squeezed. And the consumer is not yet rolling over yet. So I don't know what the level is. And I think it's crazy to pick at levels that are so far away. And I also think there's a duration of higher yields that can matter over time, because it is a slight squeezing over time. So I don't know what the level is, but I think it could be potentially significantly higher, and that will break the stock market at some point.
Mark, do you trade the deficit in any way, or is that a problem for next year?
I think the deficit is going to be an increasingly story to trade over the longer term. You can't trade it over the short term. And I don't think we're close to a Liz Truss type moment in the US. But I do think that the deficit will continue to add to a growing term premium in the US curve. Ultimately, the way you play this is through a steepener, because it's not going to be a steady move higher and higher yields, because there's going to be bouts of like risk aversion, which will see a knee-jerk reaction of yields lower. But I think the curve will continue to steepen significantly over the coming years. I think we'll see 2s, 10s go to 100 basis points or higher in terms of that spread.
Wow. Certainly something we're going to keep a very, very close eye on. I think we're less than 20 at the moment. Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you so much. You get more analysis from him and the team. Just type in MLIVGO on your terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So there's yet more earnings pain over at Kering, with the French company announcing last night that Gucci sales fell 25% in the last quarter, and some of their profits may actually hit an 8-year low in the year ahead, according to the company. Here's what's happened to the ADR in US trading yesterday, falling around 2.9%, a bit more at the low, but recovering very slightly. Now, this will potentially mean significant earnings downgrades. Analysts over at RBC saying today that while they expected a challenging print, the magnitude of the earnings erosion is much worse than feared, according to the broker there. The other earnings story, though, of course, is Hermes looking a lot stronger. Those trusty Birkin handbags selling well once again. Sales over at Hermes up around 11% in the last quarter, really bucking that trend. As we can see, Hermes is the outperforming stock in this sector. We can see that 45% drop in Kering over the past year to date, whereas Hermes pretty much unchanged, a pretty steady return for that one. Then in terms of banks, we've got Barclays out today. It's a double boost for them. The net interest income in the UK looking really strong, quelling some concerns around a potential slowdown on those numbers, and also the investment banking business really mirroring what we've seen in the US from the likes of JP Morgan and Morgan Stanley in terms of the strength. This is the second best performing UK stock this year, behind NatWest, which is a bit more exposed to the UK. They've got numbers out tomorrow, but potentially this is going to support the bulls on the Barclays share price this morning. Then, in terms of M&A, we've got news that Siemens potentially looking to do a big deal over in the US. This is for a company called Altair that does software that's sold into industries like aerospace, potentially worth $9 billion, according to the Bloomberg's deals team, which has an exclusive on this story. We can actually see Siemens underperforming the broader stock market over the past year due to concerns around their automated factory business. They're trying to push more into software, and this kind of plays into that theme. We can see it still remains a pretty favoured stock on the street with 23 buy ratings. Then in terms of analyst ratings to bring you, Michelin had some weak numbers last night in the car parts space. They're cut to hold at HSBC. Quilter in wealth management is a new buy at Jefferies, and Shell has an upside catalyst watch at Citi ahead of a big court ruling next month. Keep an eye on all of those as well today.
Joe, thank you very much. Our equities reporter, Joe Easton. Yesterday, just as a quick reminder, basic resources were under pressure. We saw that strength in utilities, Kriti, around the Spanish story that you flagged. A couple of companies cutting guidance today. One smaller one in the UK, Travis Perkins, Dassault Systèmes, also weaker on the guidance front. So we'll keep an eye on those individual movers, see how they trade.
It's got a lot this morning. London Stock Exchange, I think, could be an interesting stock story to watch as well. You mentioned Travis Perkins. That could be fascinating too. Barclays, I'm really interested to see how Barclays trades at the get-go of trade this morning. We'll certainly be watching that one very, very carefully. The opening trade is coming up next. Futures look a little positive at the moment. We'll see how they trade into the open. That's next. This is Bloomberg. Thursday morning, good morning. Let's talk about the legacy from yesterday and how we price it into today for Europe. White line Europe, blue line the States. As you can see, we tick higher after the European close. We actually tick lower and then higher in the US session. But after we see the close, we also see Tesla's numbers. And Tesla numbers look like they're going to give a lift maybe to NASDAQ futures this morning, which again is a factor we need to price in to the European get-go this morning. Kriti, what are you seeing?
Yeah, green on the screen this morning when you look at the futures picture. You look at your sector futures higher by 0.3%. That is the margin you are seeing across the major indexes. I think what's interesting, though, is we got a lot of earnings reports out this morning. So it's really a sum of all parts trade, Anna, when it comes to what is outperforming. On the surface, it kind of looks like the French market might be. You really have to look at what Hermes does to that market, as well as some of the Dutch stocks as well.
Yeah, absolutely. So a lot to focus on at the individual stock level. Let's dive into some of those. Kering then, dropping the revenues coming in lower in the third quarter. Full year guidance then had to be lowered. That down to the lowest pace, the lowest level, since 2016. It's going to take time to turn Gucci around, is the message from management. Unilever in focus. Volume, it seems to be the story there, not pricing, but that delivering for Unilever. Danone, also a one to watch within that same sector. So keep an eye on those. And bear in mind that Unilever was actually down quite heavily into the numbers just in yesterday's session. So we'll watch to see what happens there. Barclays also in focus. The pre-tax profit beating expectations. There's a slight upgrade to the full-year net interest income guidance. That's the obsession of the markets as rates set to come down, of course, further and further. The US Consumer Bank missing expectations. The CEO saying that the lender is on track for some of its cost-saving targets. Guy?
Some of the parts story then this morning. We need to factor those single stock stories into the wider index. Let's do that now. Thursday session is almost upon us. Let's give you the opening trade, give you an idea of what is going on here. We are anticipating a positive start. There's also the legacy story coming out of the States yesterday, plus fold in a little bit of Tesla positivity, and you get this. The FTSE 100 that is up a little bit, not by much, but we're in the green. We'll see whether we climb from here. We'll see what other markets do. The FTSE 100 doesn't. Actually, it does now climb from here a little bit, up by, as you can see, 0.2%. Stock 600's absolutely flat right now in terms of where we are seeing the market, but we'll wait for the CAC to open. We'll wait for the DAX to open. There's some really key stocks that we need to watch out for. Hermes, Kering, Siemens, some significant names that are reporting or delivering news this morning. The IBEX is a little flat this morning. Not much action there. Kriti, give us some of the single stock sector stories as well.
Well, I'll start with the positivity just because we're opening in the green here. A lot of it actually coming from two major names, Unilever and Barclays, showing up in the FTSE 100. Unilever also pushing up the stock 600 as well. So those are the two names to really keep an eye on that Anna had highlighted previously. Hermes seems to be Oh, we're waiting for the opening trade on that for a little bit more volume there. But Unilever seems to be, I think, the game changer in the move at the moment.
Yeah, in terms of the sector breakdown, then you've got personal consumer goods, grocery stores. That sector, that's the best performing, and so Unilever up by 2.25% as a result of that. Yeah. We also had those numbers out from Danone, and as you say, keeping an eye on what's going on the luxury space. And Hermes does seem to be up by 3.1% this morning. A very different story to Kering. Kering in focus because, of course, we heard from them last night, dropping their full-year guidance to the lowest since 2016.
Renault is the outperformer, though, on the CAC 40 this morning, just up a little bit more than Hermes this morning. It is up by nearly 3%. Apparently, the new Renault 5, which was the coolest car when I was growing up, is delivering quite nicely, the electric version of that. Danone is up, Orange is up, Bouygues is up, so the telecom sector is also having a good morning. Some of the commodity stocks as well, Total rising on the French market, which is actually now beginning to soften up a little bit, which is interesting too. So the downside is where maybe the weight is, but that seems strange given the fact that we've got 27 stocks up and 11 stocks only down. But you've got Dassault, Sanofi, Carrefour, Accor, Saint-Gobain all trailing this morning. Airbus is a little bit softer, but not by much.
But you know what's strange there is that Kering isn't one of the underperformers this morning, and you would think that it would be, just given the pain that it really highlighted in Gucci. Instead, it feels like Hermes might be lifting the stock up in respect. So that's
there's also a lot of bad. There's an anticipation that there's a lot of bad news
at Kering
that we've already priced in and factored in. So is this new news? Is it really a shock that it's going to take longer to turn Gucci around? I think to many people's minds, probably not.
Yeah, it's certainly one to keep a very, very close eye on. A lot of kind of moving pieces as well. And, of course, we are still waiting for some of the other indexes to open as well. A little bit of a mixed picture. Some of all parts. Let's take a broader view here. We're joined now by Ann Doe, portfolio manager over at Julius Baer, joining us around the table. Good morning. I think we're all trying to figure out right now what is driving the European markets. Is it still a ASML, a Novo Nordisk, as what Guy would call the sensational six, the core six, that is the granolas, if you will, that are driving the upside the way that it is in the States? Or is there more to it? Is there a fundamental bull case for Europe?
Yeah, good morning. In Europe, market concentration, it's a topic of debate, and Europe is not alone in that regards, right? The U.S. market is also pretty concentrated. That said, at the moment, you still have a preference for the U.S. market. We think that Europe, even though the valuation discount is there, these stocks are cheap for a reason. If you look at the sector composition, it's quite different compared to global counterparts. Europe is also quite exposed to some of the macroeconomic headwinds we're seeing. For example, the story so far in the luxury sector is about the Chinese consumer. Year to date, we're seeing a lot of news flow around Chinese consumer, Chinese policymakers, what they will do and not do. We think so far policymakers have not done enough with regards to policy stimulus, at least in relation to the long secular downtrend in the property market, which is really a balance sheet recession for the Chinese consumers.
Yeah.
So Europe, I think, is quite exposed to those kind of trends, which we don't see getting better anytime soon.
Give us a sector-by-sector breakdown, though. Where are you seeing, perhaps, the most volatility? You pick the direction.
In Europe, the earnings season has given us some clue as to the volatility in the subsectors, right? So far, we're seeing the most exposed area in the consumer discretionary sector. You have auto companies really seeing headwinds from Chinese consumers, but also from the global general trends in weakness in consumers. In luxury sectors, we've seen a lot of growth damage coming from just a change in the Chinese consumer consumption patterns. They've gone through 2 years of property prices decline, and maybe perhaps that they've now just started to change that consumer consumption patterns because of that lack of confidence in the economy and where it's heading over there.
What's your degree of certainty at the moment? There seems to be a lot of uncertain factors that we have to deal with. If you are going to be risk on at the moment, how convinced can you be by that, and what kind of a portfolio do you need right now to manage some of the risks surrounding that uncertainty?
It's been an uncertain backdrop for the macroeconomic environment. If you remember, in the summer, there were a lot of fears around a U.S. recession. Yep. Now we're heading closer to election. So it's an uncertain backdrop. In portfolios, we are neutral equities. We continue to like high-quality stocks. We have taken that, actively managing that over the summer.
Yep.
In the summer, coming into middle of this year, we've taken off some risk. But then in the middle of the carriage itself, we've added to risk, given the view that the long-term bull trend is intact.
Yep.
But that said, we barbell that with still a high position in cash, making sure that we have enough firepower to take advantage of any dislocation by year-end. We've also added gold to multi-asset portfolios in May, and it's been a good hedge so far.
OK. You're going to continue to add to gold? Do you like these prices as they are at the moment? Record after record.
Gold continues to exceed expectation.
Yep.
They continue to decouple from what people seen as traditional drivers in terms of yields, in terms of inflation. That said, we think this is a really long-term trend for gold. We've added to a neutral position, 3% in portfolios in London, and we think we'll assess it from here to year-end.
Okay. Can I ask you about something you just said there about the long-term bull trend is intact, and AI stands out in your notes as something that you're leaning into, like many investors, I'm sure. Yeah. Where do you see the best opportunities to lean into AI now?
AI is definitely a core thesis of the long-term bull thesis that we have. Clearly, the stock market in the US in particular has benefited from AI, something that Europe perhaps lags behind. In terms of stock specifics, AI winners, if you take a step back, the long-term winners of the previous technology adoption cycle can really emerge at the latest stage. If you think about the internet cycle, the biggest beneficiaries in software and social media didn't really exist even 10 or 15 years after the internet really came to be.
Yeah, it wasn't about the people who put in place all the Wi-Fi connections.
The infrastructure,
and the
right?
infrastructure, yeah.
Exactly. So we see it in a few stages. At this point, the infrastructure is still important. So we still like semiconductor plays within AI. Those key component providers will remain key. But we are open-minded as to the next few phases. For example, in software stocks have lagged semiconductor stocks quite a lot year to date. But as the AI cycles continue, as software companies are where the monetization of AI is, we continue to lack exposure there as well. So there's a lot to be said about continue to keep an overweight in technology because that trend can broaden out.
We've talked a little bit, and you've mentioned in passing Europe's reliance on Chinese consumers, and that's a story we've revisited time and time again over recent months, it seems. Is this still a cyclical story, or is there something more structural happening here? Changing tastes in the market, a changing focus for the consumer, what they want to spend their money on? I mean, what is happening in the sort of the Chinese consumer space? Because it does have such an impact on these European luxury names in particular.
Absolutely. In the midst of this cycle, it's difficult to disentangle what is structural and what is cyclical. I think there are both elements. The structural story is that the Chinese economy is going through a balance sheet recession. It's our view that we don't think policymakers have done enough to address the deleveraging issues as well as demographic issues for which there isn't an easy cure. So there is that structural element that we think will stay. The cyclical element is of course, tied into what policymakers, their increased appetite to stimulate the economy. But we don't think they've quite done enough.
Because a lot of these consumer companies, they say it's hard to assess the stimulus and whether it's going to make much difference. We heard that from Kering.
Absolutely.
And walk us through the sensitivity, or maybe lack thereof, between the stock market and the bond market. And I have this in the context of simply a major bond move that we're seeing this morning in UK gilts. The 10-year higher by about 5 basis points in terms of that yield. How should we be thinking about what's happening in the bond market in terms of the effect on the stock market?
Absolutely. In terms of the bond markets, I think the Fed really set the tones. And therefore, more recently, I think the fact that the election is on the horizon really comes into the picture with all the talks of fiscal deficit. You're seeing 10-year bond yields in the U.S. up higher by close to 50 basis points in the last month or so. So the U.S. set the tone, and the gilt market doesn't exist in isolation. When do equities start to pay attention? I think it's regard to how fast bond yields can rise, right? So far, 1 month at that pace, it's been pretty gradual rise. But that said, we're on the watch for the reason why bond yields are going up. Because if bond yields are going up because the economic growth is doing well, because the U.S. economy, unemployment remains quite controlled, inflation is controlled, then there's still reason for equity markets to continue to outperform, given the core driver being economic growth. We'll continue to see the volatility in bond markets and the speed at which bond yields can come up.
So I think the market's missing at the moment. It's interesting to see what's happening in commodities, which actually, in some ways, apart from gold, actually look like they haven't had a great run. Well, they haven't had a great run. Do they look mispriced right now? Is there a space on the curve that looks mispriced? Where do you see the dislocations right now? Are there any anomalies that kind of stand out that you're looking at, trying to examine? As you discuss this around the table, you're saying actually maybe there are areas in which the market is getting it wrong, or is the market always right?
Interesting question. In terms of market expectations, which is the core of your questions,
Yep.
Coming into this earnings season, we're seeing a revision down in terms of expectations of earnings growth. That said, there is a broadening of this earnings growth. Right? In the next year, you're seeing the driver of earnings growth not being so concentrated anymore. We are cautious about that view. We think that the economy in the U.S. has continued to grow this year. Will it continue to deliver the same pace next year to deliver that broadening of earnings growth?
Yep.
We're not too sure. So at the moment, we still favor the long-term secular story in our stock selection because there is more confidence to that longer-term view as opposed to a more cyclical-driven earnings revisions for the broader market.
Okay. And that from Julius Baer. Thank you very much indeed. Still trying to figure out what's going on in gilts. Anybody got any answers? Please let us know. always interested. The core six looks a little bit like this morning. This is the picture that we are looking at, a broadly positive picture, as you can see, pretty much across the board. It's not been often these days that we've seen every single one of these single stocks actually moving in the same direction, i.e. higher or lower. Today, we definitely get the higher story. Let's find out what else we're watching this morning. Joe Easton, over to you.
So we are actually seeing positivity in the luxury sector, as you guys were mentioning just a moment ago. So Hermes getting that 11% sales jump overnight in terms of their quarterly earnings on the Birkin bags that they can't sell enough of. But Kering actually gaining as well, up 2%. Now, bear in mind, that stock is down around 45% on a year-to-date basis. And traders saying exactly that. This is really just bad news already priced into the stock. So really no further losses to come at the moment for that one. Both of those stocks firmly in the green at the moment. Then another stock doing well in France is Renault, bucking the trend of a slowdown in car sales in Europe. The R5 model, as Guy was mentioning earlier, doing really well. So that actually a bit of a boost for Renault this morning, up almost 5%, outperforming really today. Then in terms of Unilever, Anna mentioned earlier that stock fell yesterday. This was after some Asian units, the India and Indonesia businesses reported sales early. It hit the stock, and we're basically just recovering all of that today as the Ben & Jerry's ice cream maker reports pretty strong sales for that one this morning. Barclays edging up following those better-than-expected UK net interest income numbers, and also going the other way, down in the car space, autos in tyres as Michelin, we mentioned earlier, really weak numbers out of them last night. And HSBC coming early, already downgrading the stock, no longer recommending buying following the downturn there. Carrefour, meanwhile, over in groceries, that actually looked weak in the US trading in their ADR, but actually holding up pretty strong at the moment in terms of that one. Then we also had Danone, Activia, water and yogurts. That's the company over in France as well. Now, that one gaining pretty strong numbers. That is a pretty strong and steady company in terms of their sales, a bit of a defensive one. Activia yogurts that we all love. That one gaining at the moment. In terms of some other news away from earnings, we've had quite enough earnings today. Siemens, we mentioned that deal around $9 billion, according to a Bloomberg exclusive for a company called Altair in the US. We'll wait for confirmation of that one, but the stock edging very slightly lower. Eni over in Italy selling a big stake in their Enlive decarbonisation platform to KKR, according to breaking news on that one. And Mike Ashley is back at it again in the UK retail space, trying to get the CEO position at Boohoo, according to a statement that broke on the terminal at 7 a.m. He's looking to muscle his way in there in terms of the UK retail magnate. Finally, just one morning call. This one really stood out to me. Shell. It's a neutral over at Citi, but they've opened a 30-day catalyst watch because there's a big court case coming up next month around their carbon levels in The Hague in Amsterdam. And Citi reckons that will be favourable. They think you should be buying into that court ruling. So that one edging very slightly higher for Shell in London this morning.
Joe, thank you. Joe Easton with an update on some of those corporates that are in focus this morning on the back of a host of earnings stories. So we continue to make pretty decent gains, actually, across European equity markets, up by 0.5% on the stock 600. We are getting numbers from the French economy. We're getting PMI data coming through. The manufacturing PMI dropping below estimates, so continuing to be weak there, 44.5. And the services number also coming in below estimates and continues to be below 50. So unlike Germany, all of these numbers are in negative territory again, have been, were previously, and continue to be in not negative, sorry, below 50 in contraction territory. So I suppose, we've made that leap already, but these numbers coming in lower than expected, and we are seeing some weakness in the euro on the back of that.
Yes, we definitely are. 107 handle is where we started the day. It looks like it's slightly bounced back. You're not pairing that initial kind of knee-jerk reaction that you saw. The bond market, to me, is what's getting interesting, though, because you are seeing, of course, movement off of this data set in all of the European yields. We should talk for a moment about what's going on in this gilt market as well. About a 5 basis point move to the upside on the 10-year. Some folks pinning this to the comments of Andrew Bailey in the last 24 hours. Others saying that this is just a positioning story. When you look at cable, we're still at 129. The move isn't that as high in the currency market as it is in the bond market.
Yeah, it seems to be mostly a bond market story, doesn't it? And he did say last night that the disinflation trend is happening faster than expected. You might have expected that to mean yields go lower. Was it about the nuance? Was it about some of the lines he said about services inflation?
Is it about him at all? Or is it just the budget's coming?
Maybe it's that. We are only days away. Next week.
Absolutely. France remains trapped in an economic decline as the fourth quarter begins, with challenges from the third quarter persisting. Those are the comments surrounding the PMI data out of France that come with the data this morning from an economist at Hamburg Commercial Bank that is listed here on the press release. The numbers really don't look good. France's private sector economy registered a further deterioration in October. Business activity shrank at its quickest pace since January. The numbers, again, out of France look pretty ugly.
And we have seen that the two-year curves in Europe are certainly responding to this. We put up the data on the 10-year and showed that there was a little bit of response there. But we see the two-year horizon really responding. So 7 basis point moves in France, in Germany, and Italy, also not down quite so much in terms of yield, but down a little. Coming up on the programme, we'll get back to some of the other corporate stories. Talking of France, Hermes gaining this morning as the Birkin bag maker shows resilience amid a wider luxury slump. We'll get a deep dive on those results next. This is Bloomberg.
Twenty minutes into the equity session, this is what we look like this morning. A broadly positive picture. As you can see, we're up by, let's call it, circa 0.5% across Europe. The luxury sector is actually doing all right this morning. Even Kering's having a fairly good morning. But the standout story continues to be Hermes. Its shares in the green this morning. The company reporting a rise in sales. It says here retailer. I'm not sure we can really classify Hermes as a retailer. Pricey handbags. Nice things, basically. Broad luxury doing reasonably well at the moment, but Hermes continues to outperform. Chloe Mele joining us now around the table to talk about this. Is it just different? Is this company just different to everybody else?
Well, it seems like it is. It does seem like that. So it's yet another good, resilient quarter, another quarter of outperformance for Hermes. I think it is still worth noting that in terms of quarterly revenue growth at constant currency, it's a little bit weaker than previous quarters, but we're still talking about double digits, which is something that some of its peers would only really dream of. And so it is bucking the trend. It does seem that way. There's still a little bit of weakness in China. So sales in Europe, the Americas, Japan, that all exceeded estimates. But if we look at the region, including China, that came in below estimates. So the fact that the consumer confidence in China is kind of reaching pandemic lows, it does still have an impact on Hermes, even though it keeps that kind of edge over its peers regardless.
But it feels like so much of the edge is really just coming down to the Birkin bag. And we've been talking about this for years now in terms of what's going to make a dent into the wealthiest echelon of consumer. Do we have any clues on that?
Well, Hermes, the reason why it's been really able to withstand that pressure is, as you said, is because it's just so high-end. You know, that means that it comes with a kind of a loyal customer base. It comes with an exclusive price point. You know, if you can afford a Birkin bag, you can afford it regardless of the circumstances, regardless of the economic slowdown. I think in terms of, and you can see that as well in terms of the segments in Hermes, so the textiles, silk and textiles, that's a bit more of an aspirational segment, and that's also kind of a weaker division. So it's a story that we've seen over the last few quarters that still continues this quarter, where, you know, the resilience comes with being really high-end, and it's going to be a bit more difficult for the companies that are a bit more aspirational, and we can see that with Gucci also.
Chloe, yes, we did in the Kering numbers. Thank you very much. Thanks for the update, Bloomberg's Chloe Mele, with the latest on Hermes and the luxury sector. Let's turn to another earnings story this morning. Barclays shares higher after delivering a profit beat. The CEO has just been speaking moments ago, saying the UK and the US are on track for a, quote, feather soft landing. That's a nice line. Let's bring in Bloomberg Intelligence senior banks analyst Philip Richards. Philip, good morning. So clearly Barclays will be hoping to make the most of that feather soft landing, if that's what we get. What have been the key drivers then? We saw an 18% rise in profits in the third quarter. What are the key drivers?
Yeah, hi. It's been across the board beat, I'd say, overall. Revenues are slightly better, costs are slightly lower than expected, obviously positive, and loan loss charges also coming through lower. And it's been the UK bank which has really been the driver so far. And elsewhere it's pretty much in line. So yes, it's positive, but I wouldn't say it's outstanding. It's not a blowout sort of numbers.
NII guidance is up. Where's that coming from?
Well, it's coming from basically the margin holding up firmer than expected, and also volumes have been picking up in terms of those rates starting to come down. But that guidance was only for this year, 2024, and that's pretty much in the bag already. Consensus was already there. What we all care about is what about next year, about 25.
Absolutely.
And the bank were very quiet on that.
Right, and so on that NII story, it's interesting, isn't it? Because it's a bit like the US, where NII held up better than expected for certain banks. But also going into these numbers, I was reading that many analysts say that Barclays, actually I think they said it about Lloyds as well, has a structural hedge to the declining rates environment. So is this about Barclays specifically, or is this about UK banks?
It's UK banks, and that structural hedge will support them all in terms of the low impact on the NII, but also 2, 3, 4 years forward, can they maintain that revenue momentum? That's what's key for them. And Barclays have these big 2026 targets, and consensus is somewhat below those levels. So yes, this year's in the bag. First half next year is fine, but what about the second half next year into 26? Can they sustain that?
One of the standouts of the U.S., though, when that kind of hedge against the net interest income that Anna was talking about was the fact that investment banking and some of the deal activity was surprising to the upside. Is Barclays getting in on any of that?
They are. They do see themselves as, the European competitor to the big US players. The US is a big bullish bracket, but corporates still want to have a European angle on that side. And actually done very well on that. Their fee income's up very strongly. They've beaten estimates on fixed income, on equities as well. So yes, overall pretty strong on that front.
It's a fascinating one as we talk about the capital markets activity and kind of coming back, maybe deploying some of a lot of those funds that are caught up in the PE space. Philip Richards over at Bloomberg Intelligence, we thank you so much for giving us that insight. Of course, as we're speaking, the bond market is going wild, for lack of a better term, whereas the currency market feels a little subtle. I mean, we're looking at a currency market of 107.71, on euro dollar, 129.47 on cable, to match, by the way, 5-6 basis point moves in the European curves.
So you got the PMI data out of France this morning, which looked super weak. The commentary coming out of market on the back of it is really, really bad. First time we've seen the service sector and the manufacturing sector deliver job cuts in the 4 years. We're talking about confidence within the manufacturing sector back down to 2020 levels. These are really grim readings, and it's understandable maybe therefore why the market is pricing in the front end, maybe to deliver a few more cuts from the ECB.
Yes, so traders now favouring a half-point ECB interest rate cut in December. We see that reflected. The 2-year, we do see a lot of movement. Kriti, as you've been saying, those yields really coming down, 6 basis points on some of them at the short end. In the UK story, things look a little different, as we've been mentioning. I wonder if there's a bit of rotation there, a reassessment of just what kind of rate cuts we're going to get from the ECB versus the Bank of England. We're going to get some more data, though, on Germany, aren't we, just coming on the other side of this break. We're going to get data there. Will we see services below 50? The expectation is we don't, but if we did, then all measures on the German economy would be below 50. We'll certainly focus in on that. We'll also have a conversation about family offices. They're pouring their money into risk assets. We'll talk through their performance. This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session. Seeing green on the screen when it comes to the European stock market. And this is some broad gains despite some of the mixed earnings stories that we've got across the continent. We are also seeing German PMIs break across the term right now. The services PMI rising to 51.4. The forecast there was 50.6. Manufacturing PMIs coming in better than expected, but still below 50 in that contraction territory. 42.6 there. The estimate was 40.8. This is, of course, coming on the heels of that French PMI data that we got, which suggested the exact opposite of what we're seeing in Germany.
Right, so the euro being whipsawed, we're also seeing a little bit of movement in bond yields. So bond yields across the eurozone had been dropping today. That was reinforced by what we saw on the French data. We're seeing a little bit of a pairing of that yield drop just now on the back of the German data, which doesn't necessarily didn't move in the same direction, but we're still talking about a lot of weakness in some areas of the market. Although, is this manufacturing? I mean, bouncing along the bottom is the phrase we've used for just so long to talk about the Eurozone manufacturing story. It's still not in expansion territory, still contracting, 42.6. It is better than the estimate of 40.8. But that's the only green I can.
Bouncing along the bottom probably is maybe the way of looking at it, but certainly better than anticipated. Certainly seems to be the story. In terms of kind of where we're seeing that, the service side is obviously interesting. Manufacturing does continue to be an area of concern. The dearth of incoming new work was reflected in a further sharp increase in outstanding business in October. Firms, therefore, are looking to reduce staffing capacity, resulting in a fifth straight monthly decline in employment. So there is still quite a lot of negativity embedded within this. It's just slightly better. Kind of things are pretty grim in Germany, and there is obviously maybe a little bit of positivity coming out of this, but I think it's fairly scant.
I think there's also a point to be made here in the market reaction. Anna mentioned the 2-year story as well. You're seeing a little bit of spread widening, slight spread widening between the French and German debt, though. The rest of the periphery, those spreads actually closing in. So we'll see how that all shakes out in about 30 minutes' time, Guy.
Yep, firms forecasting activity to rise in the coming year.
He is deep into the PMI statement
I
now.
am. This is good stuff. We'll move on in just a minute. It is interesting to see where this is coming from in terms of the fact the firms in Germany are talking about a potential pickup. Let's talk about what else is going on. How do you manage all this? The world is a super confusing place right now. You've only got to look at compare and contrast the French and the German data this morning. So how do you deal with all that, and how do you factor that into a portfolio? Well, the world's wealthiest individuals and their families have significantly upped their portfolio's exposure to equities this year. This, according to a recent survey from Citi Private Bank. The Family Office report shows more than 40% increased equity allocations, with the strongest pivot in Asia. More than a third cut their cash holdings. We're joined now by Hannes Hoffmann, head of the Family Office Group at Citi Private Bank. Morning.
Good morning. How are you?
Nice to see you. Look, the world's a really confusing place right now. If I look at the read I've just read and the data you're giving us, it would seem to signal that we are very risk-on in the family office space. Is that a true reflection of what we're seeing?
Well, look, so the first thing, thank you for having me here, Guy. The first thing is we did the survey now the 6th year in a row. So we've got a history of looking at data of the biggest family offices around the world. There's a few things that stood out for us. The first thing that stands out is we've seen a lot more family offices participate than in any year before. So we used to have somewhere between 80 and 150 participants. This year we had 340, which makes this the biggest survey in the industry. 340 means we've got a really good insight into what families are doing around the world and very good quantitative and qualitative data that we can use. So what we've seen in this survey with so many family offices participating is that definitely there's risk on sentiment, right? So family offices have gone into it last year with a lot of worry about inflation and where would rates go and would we go into a recession. This year, the sentiment is completely different. We've seen people take money out of cash, like you've said, move into fixed income, into private equity, into public equity, and they're doing this with a very positive outlook for next year. So what's interesting, in the last 12 months, we're seeing positive returns for about 80% of family offices. So they're coming from positive experience and positive expectations of 97%. So what's interesting, 97% of family offices we've interviewed are expecting positive returns next 12 months, which is the highest number in the last 6 years. So is the sentiment bullish? Absolutely. We've seen that in asset reallocation, but we've also seen that in the performance expectation that these folks have coming from a strong past 12-month period.
But they're buying bonds. So there's some hedging going on here. Is that what that is for? Like, how do they hedge that risk? I'm presuming this is a multi-generational process that unfolds here. It's about wealth preservation as much as capital increase. How are they making sure that the wealth is preserved and can grow in the future?
Well, look, I would say the most important thing here is they're looking at asset allocation as their number one tool to achieve their investment returns. From an asset allocation perspective, there's different asset classes to invest into. So you're saying they buy bonds. They did move cash from cash into bonds, so into longer dated fixed income. But the biggest moves really have been in the equity space if you look at private equity and public equity together. Let me give you an example. 77% of family offices invest into direct investments. Of those that invest into direct investments, more than 50% have increased or significantly increased their direct investment activity. That's investments into companies in Series A, B, C, D, typically earlier than pre-IPO, but not as early as we see. So we see and pre-IPO are kind of like smaller allocations, but the ABCD, the classic investing into companies with a proven business model, that is something that a lot of them do. So it's not about buying bonds, it's about reallocating out of cash into other areas that generate better returns, including direct investments, private equity, public equity, and fixed income.
And Hannah, so help me join the dots here then between what we're seeing at the sort of geopolitical level and what family offices are doing. Are family offices concerned about politics? Do you see them trying to protect themselves from what might happen or even just volatility around the US election? Is this something that they're very preoccupied by? Or are they just, they just think it doesn't matter to their portfolios, they're protected, it's just short-term impact? What's the view there?
Well, so Anna, it's very interesting that that you asked that question. I think when we look at one of the questions we ask in the survey is, what are the main risks you're concerned about? And in previous years, inflation was usually the number one risk. Not surprisingly, we're now in an environment where a lot of the family offices are saying inflation is not that important anymore. So it's dropped to like number 4 of risks. The number 1 risk is the interest rate circle. Geopolitical uncertainty is also up there. What's interesting, just for people who actually see the survey says that the Middle East is only the number 6 risk, so fairly low down. But I think that has to do with the timing, because that was taken in June of this year. And as we know, over the last few weeks and months, the situation there has increased. So they're very risk aware. They're very focused on what the opportunities and risks are, especially now with the U.S. election. Obviously very binary in terms of the policies that will be implemented. People are positioning for that. We're seeing that in some of the key data. For example, 70% of family offices have concentrated stock positions. Of those that have concentrated stock positions, a third are looking at doing something with them, and the majority using derivatives. That indicates to us that what you see is a lot of interest in how do you use low volatility in markets to potentially position, protect concentrated positions, potentially like exit them with enhanced yields. And we're seeing a lot of requests for this kind of activity to coming in.
You mentioned earlier about this move from cash to long duration fixed income. The biggest risk in that part of the curve is the deficit. How do you price in the deficit for a long-term investor?
Yeah. So what's interesting about the deficit is people are definitely concerned about that. Two ways to look at this. One, you have to weigh the risk of the deficit with the short-term path of interest rates, right? And as you know, when the Fed started like its easing cycle at about 5.5%, people expected, market expected, rates to go down to well below 3%. I think most family offices thought that was too aggressive, but they still thought that there was a trade-off along the curve. When it comes to the deficit, people do try to invest into that through credit and through equity investments. And another topic that we should briefly touch upon that we're seeing a lot of family offices talk about is global asset security and global mobility. So where, from a location strategy, should people go that deficits might be increasing and tax rates might be increasing? People are aware that now corporate profits are 12% of GDP. 40 years ago, it was 6% of GDP. So.
Okay, yes, but that part of the curve was also responsible for this kind of bond crash, basically, in 2023 as well. Can you still look at it as a hedge, though? Or is this kind of still a scary part of the market, I guess is my question.
You mean the fixed income?
Yes.
Look, I mean, again, it's all about portfolio construction and how you combine a portfolio of treasuries, of...
Well, how are you combining it?
Well, we're definitely recommending that clients invest into fixed income securities as part of their portfolios. Here's one thing that's interesting. What differentiates family offices from other investors is that they can take a really long-term point of view. And so what we're finding is family office portfolios resemble university endowments a lot more than other institutional investors' portfolios. So we're seeing about a 40% allocation to alternatives, which is much, much higher than what we see most investors do. And that 40% allocation to alternatives works very well when you take a multi-generational view. And so generally, their fixed income allocations are less than other investors, with a bigger emphasis on long-term investing. And that should provide to many of them some sort of a hedge, if you want.
Hannes, nice to see you. Thanks for stopping by to see us and bring us the report. Hannes Hoffman from Citi Private Bank. Thank you very much indeed. Bit of breaking news while we've been having this conversation. The European Union's top court sided with Intel in a case that centres on abuse of market power. Intel's having fairly mixed news at the moment. Here's a piece of good news. So winning that fight, this is an antitrust case that has been going on for quite some time, Kriti. Generally, actually, it's been fascinating to watch how some of these technology companies have fared in both cases in the United States and here in Europe recently. Obviously, we watched what happened with Ireland. It's now interesting to see that the European Union may be having another setback when it comes to Intel.
Yeah, not a surprise here that the courts have been aligning the court's been aligning with the companies themselves.
Yep.
This is also a big question as well in terms of the amount of fines, because even the fines that were on the docket were something like 400 million euros among one of the fines, among others, it's not a very big number in the context of what Intel has to deal with. So, of course, that is the tech story that we're going to be keeping an eye on in terms of the ripple effects to other places. In the meantime, let's talk about another thing going on in another part of the world. That is Nvidia CEO Jenseen Huang has just been taking part in a fireside chat with Mukesh Ambani, of course, one of the major billionaires, the richest person in India, and arguably one of the biggest in the world, on the future of AI in India. Take a listen to what he had to say about technology in the country.
In order to lead in artificial intelligence, you need to have AI model technology that India has. You need to have data, massive quantities of data. And using the last thing you need is AI infrastructure. And we're announcing that Reliance and Nvidia are partnering to build AI infrastructure here in India.
Absolutely.
So Jenseen Huang talking about that partnership with Mukesh Ambani. And I think the context for an international audience is really important here. Mukesh Ambani is the chairman of Reliance Industries. It's the biggest conglomerate in India. And one of the key projects he's taken on there has been bringing internet and kind of the telecom sector to the masses through this major project called Jio, which is Hindi for life. It basically is this underlying story that you basically have to get over 1 billion people online and on the grid. How do you do that? With NVIDIA chips.
Right, and then this is creating then some of the excitement we talked about at the beginning of the week around investment in India for the access to that large population and what it might do, but also because it has a great place to test what you can do with consumer-facing technology products. So I spoke to Process earlier in the week, and that was the point they were making about how excited they were about things they were doing, consumer-facing technology products in India.
It's going to be interesting to see what does this all mean for the Indian stock market, which has had an absolute tear of a run recently.
Yeah.
And I'm just wondering whether that's actually beginning to conclude, whether all the good news is already priced into this as a market and it's going to struggle to make headway from here. You then factor in also the fact that people are going to be maybe moving money out of India and putting it back to work in China. Just from a market point of view, have we seen all the good news from India?
So India is really tricky here in terms of these partnerships, especially when they partner with critically important companies like Nvidia to the world, because historically they're very careful about who they partner with and who can actually access the Indian subcontinent. So the fact that they're opening their doors to Nvidia is important. I'm curious though what kind of tailwind it does for pricing. If you suddenly have this much demand from one of the biggest and most populated countries in the world, can Nvidia match all that capacity? I don't know.
We will continue to watch that story. Coming up on the programme, we've had the data out of France. French services PMI comes in lower than expected, but some reprieve then, perhaps from Germany, with the manufacturing print there coming in slightly better than expected. The services number did not drop below 50. We'll discuss all of that, the slightly mixed signals, the slightly better news coming out of Germany. We'll talk about what it means for the ECB. That's next. This is Bloomberg. Welcome back to the opening trade. 8:48 here in London, 9:48 if you are in Paris or Berlin, and digesting the latest data coming through from the French and the German economies. Now, traders have upped their bets on a half-point ECB rate cut in December. This after the French services PMI came in lower than expected. But then that was followed in Germany by perhaps some reprieve, with the manufacturing print coming in slightly above expectations, but still below 50, still in contraction. Joining us now, Maria de Mertzis, chief economist for Europe at the Conference Board. Do you see any green shoots of recovery in this German story, Maria, or are you broadly still pretty downbeat on the Eurozone economy?
Well, talking about Germany first, I certainly am downbeat on Germany. The numbers, as you said, are still pointing to a contraction for Germany. So I don't expect a revision of our forecast for the German economy and therefore for the European economy. All the numbers are pointing in the wrong direction, including consumer confidence, export orders that are dipping into 4 years. Low numbers. These are not good news. And of course, the other thing that is coming in, which is rather negative in my view, is the investments on the chip industry. A huge support given to America, to many firms, including American firms, to invest in Germany on the chip production to support the electric vehicle industry, and that is actually stopping now on the back of negative numbers in terms of the uptake of electric vehicles in Europe. So all of these things, which have a medium-term perspective, are not very positive. Germany hasn't convinced the markets that it can actually do better and revive its manufacturing growth. And this is the bit to watch. How do investors and investments take up in Germany and therefore help the German economy and the European economy at the same time?
OK, and Maria, I know we've talked to you before about the Draghi report, and you find a lot to like in the Draghi report and the suggestions that the former ECB chief makes. He's broadly calling for a lot of reform, and he wants a lot more money to stay invested in Europe. How do politicians join the dots then? Because they look at this negativity in the data out of France, out of Germany, and maybe they want to take action. But it might be difficult to make that link between the weakness now and what Draghi is suggesting. Can you give any words of advice as to how they do that?
Patience is very important, but in order to have that patience, you also need to have hope. And for that, I'd like to see an industrial policy strategy that spans across the EU. Look, there is issues of economic security that are of prime importance in the European economy. This is what I would like to see handled. The example of the chips investment in Germany is a case in point. This is of crucial importance for European industry. I would like to see the weight of the whole of the EU behind the support of critical industries that are going to help the economic security issue. And the fact that the EU is not supporting Germany in this is actually the one thing to fix. And I would argue that this is exactly what Draghi argues in his report. Find those industries that are critical for the European economy, either because they are frontier industries or because they are crucial for economic security, and throw your weight behind them. But of course, in Europe, when every time we support one industry, somebody else has to be supported elsewhere, irrespective of whether it is necessary or not for economic purposes. This has to stop. We need to have a holistic industrial strategy, very much in the likes of the way that Draghi explains it, and shift the weight behind this support. A grand bargain type of thing has to happen in the European Union in order to make advances here. I would like to see the chip industry being supported in Germany and the Netherlands, and in the process of doing that, design a strategy of how we're going to achieve our strategic objectives in the medium run. This is not for next year. Even though I'm quite pessimistic on Germany, I would argue that if we manage to follow this advice that comes from the Draghi report, we will see benefits in 5 years from now. And that's absolutely essential.
Maria, but so much of that strategy that you're outlining, I think, would argue relies on subsidies, something that you've seen, of course, happen in the United States, which you pointed out as well with the IRA. But Emmanuel Macron makes a crucial point, which is that how can Europe compete if they don't subsidize in the same way that the United States does? I'm curious if Europe even has the money to provide those kind of subsidies. What do you do when the budget is in tatters and you still need to help the economy?
It is true that national budgets are strained, but to argue that the European Union doesn't have the money to support, I think is not correct. If we were to issue common debt, and of course there is a big if here, but if we were to issue common debt, there will be absolutely no problem financing that debt. We need to convince Germany, and we need to convince the Netherlands, if we are going to finance our industries, your industries, because they are important for the security of Europe, something else needs to give. And I would argue that issuing common debt to finance strategic investments elsewhere is the way to do it. That's the grand bargain. Find the willingness to support frontier industries in Europe, which inevitably are in the geographical center of Europe, that there are countries like Germany or the Netherlands. Finance those because they are frontier. This is where productivity gains will be quick to achieve. But then give something else in terms of strategic investments to the rest of Europe in order to make sure we continue with the green transition and therefore finance growth in the rest of Europe. This is, in my view, the way to go.
That all sounds great, Maria. But in 2 weeks' time, we could have a trade war with Donald Trump. What's that going to look like?
That's right. We saw the European Commission actually following some of the suggestions of the Draghi report, which was on trade differentiation. Sector by sector, industry by industry, find those that matter to us and go for it. I'm not sure this was the right thing to do. It was, one would argue, a quick gain in this respect. But who benefits from these EV tariffs? You saw immediately that the investments on chips for the electric vehicle industry actually they're standing back. I'm quite skeptical about who wins from these tariffs. But this is Europe. Small, a few steps forward, a few steps back. I'm hopeful net gains are steps forward.
Hopefully. Maria, thank you very much indeed. Maria de Metzis, Chief Economist for Europe at the Conference Board. I want to talk about some of the equity markets in Europe this morning and what they're doing. The CAC 40 has got some really interesting stock stories in it this morning. Hermes is definitely one of them, but Edenred is another. The stock halted for volatility for a while. It is certainly under pressure. I've got it down by 14% on my board. The numbers have missed. The operating revenue coming in certainly significantly light. It's certainly seeing a big hit in terms of its EBITDA as well, what it sees in terms of that going forward. It's being reacted to very strongly in terms of this miss in this single stock. This is one of the stocks that took a while to get open this morning and has been really jumpy ever since.
Yeah, absolutely. That's the Edenred story. And as you say, a really big sell-off. In terms of points off the CAC 40, it's actually Michelin that's taking more points off there. And that obviously, that not picking up any of the positives around the Renault story, instead reacting to the fact that the business has trimmed its guidance. So the Michelin story, again, around cars, around tyres and around everything's auto, all looking a bit gloomy still there.
I guess that makes me the ray of sunshine with some of the luxury names here. You got Hermes rallying, you see Kering as well up there. Even Total is taking a little bit of a beat, and I believe it's called Danone. It's always going to be Danone in my head, but Danone.
Yogurt. Can you draw a line there between French politics and what's happening in terms of the chaos we're seeing around French politics? The PMI data we're seeing, which is pretty bleak this morning, out of market in terms of the data that is being delivered, and what is happening in the CAC 40 right now.
Yeah, maybe. I mean, that's why I was asking Maria de Metzis to help politicians join the dots between the weakness in the data and the things Draghi says need to happen. How do they pitch those? How do they sell those to a population that wants things sooner rather than later, and maybe some of these take a while to deliver? Shall we talk about some of the things that are still coming up? Bloomberg in conversation, some great conversations happening today. 1:30 p.m. UK time, an interview with the Bundesbank president, Joachim Nagel. Well, what will he have to say about this increasing expectation around a 50 basis point cut from the ECB? Later, we'll hear from the Banco Santander executive chairman, Anna Botín. That conversation later. The UBS CEO, Sergio Ermotti, joining at the US close. You can catch all of those conversations starting from 8:30 p.m. UK time. So a lot of that coming to us from the United States. That is it for the opening trade. A busy day. Stocks are up. The Pulse is next. This is Bloomberg.